Watch this. You just bought $100 of Apple stock. One tap. The money's already gone from your bank. And here's the strange part. Apple never got a cent of it. Not one. So where did your $100 actually go? Because someone, somewhere, just received it. This video follows that money every single step until we find the person who ended up with it. Most people picture buying a stock like this. You hand a company money. The company uses it to build things. You own a slice. Clean and simple. It's the whole reason people say, I want to invest in Apple. You feel like you're backing the team, but that picture is almost completely wrong. When you bought that share today, Apple's bank account didn't move. The company doesn't even know your name. So if the money didn't go to Apple, who did you just pay? Hold on to that question. To answer it honestly, we have to follow the $100 slowly, one step at a time. Let's give your $100 a tracking number, like a package. And let's follow it. Step 1. You tapped buy inside an app. Robinhood, Fidelity, Schwab, whichever you use. That app is your broker. And a broker is just a messenger. That's the part people miss. Your broker doesn't own any Apple stock. It can't magically sell you a piece of Apple. All it can do is carry your order to the place where stocks actually change hands. So your money's first stop isn't Apple. It's your broker, holding your $100, waiting. Waiting for what exactly? For someone on the other side. Because here's the rule underneath everything. For you to buy a share, someone else has to sell one. A share of Apple isn't printed fresh the moment you click. It already exists. Somebody already owns it. And for you to get it, they have to be willing to let it go. Your purchase isn't a delivery from the company. It's a trade with a stranger you'll never meet. So who is this stranger? To find them, your order leaves your broker and goes to a place called an exchange. You've heard one of its names, the NASDAQ, the New York Stock Exchange. But an exchange isn't a building full of money. It's a matching machine. Its only job is this. Take everyone who wants to buy Apple right now, take everyone who wants to sell Apple right now, and pair them up. Millions of times a day. So the machine looks for a seller to match with you, and it finds one almost instantly. Maybe it's a retiree cashing out a few shares. Maybe it's a giant pension fund. Maybe it's a firm called a market maker. We'll come back to them because they're sneakier than they sound. The point is, a real someone on the other end is handing over one share of Apple, and your $100, it flows straight through the machine and lands in that seller's account. That's it. That's the answer to our opening question. Your money went to the previous owner of the share. Their cash out was your buy-in. Apple watched the whole thing happen and received nothing, because Apple wasn't part of the trade at all. Sit with that for a second. Every day, billions of dollars of Apple stock get bought and sold. And on almost none of those trades does Apple see a single dollar. The company is like a famous painting. People pay fortunes to own it and trade it, but the artist who made it isn't in the room. Oh, and that market maker I mentioned, here's the sneaky bit. When your free trading app sends your order to one of them, the market maker often pays your broker a tiny fee for the privilege. It's called payment for order flow. That's part of how free trades are free. You're not the customer. Your order is the product, which leads to a genuinely uncomfortable question. If Apple never gets your money, then does buying Apple stock help Apple at all? Are you actually investing in the company or just trading a collectible with strangers? And this is where the whole thing flips, because there was a day when your money would have gone straight to the company. Exactly one kind of day. It's called the IPO, the initial public offering. The very first time a company sells its shares to the public. That day, and only that day, the money flows the way you always imagined. Investors hand over cash. The cash goes into the company's bank account. In return, the company hands out brand new shares it just created. When Apple went public in 1980, it raised over $100 million that way. Real money straight into the business. But after that first sale, those shares are loose in the world. And from then on, every time one changes hands, it's just one investor paying another. The company's already been paid once, at the start. So the honest answer is, buying Apple stock today doesn't hand Apple money. What it does is move the price. So let's be clear about what you own now. Not a promise, not a loan. You own a sliver of the company, a real legal piece, tiny but real. You get a vote. You get a share of the profits if they pay them out. You own a genuine slice of one of the biggest companies on Earth. And even though your purchase gave Apple no cash, Apple still cares a lot about that price you helped set. Here's why. The company's founders and employees own huge piles of these same shares. When the price goes up, they get richer. When it drops, they feel it. And there's a bigger reason. Remember the IPO, the one day the company can sell shares for cash? A company can do that again. It can print and sell a fresh batch of new shares later. And the higher the price, the more money it raises when it does. So the price isn't just a number, it's the company's future ability to raise money. That's why they chase it. Which brings us to the scariest version of our question. When the market crashes, when headlines scream that $1 trillion was wiped out, where does all that money go? Here's the twist. It doesn't go anywhere. Because it was never a pile of cash sitting in a vault. A stock's value is just the price of the last trade. If the last person paid $200 a share, everyone says their shares are worth $200. But the moment buyers only want to pay $100, the value is $100. Nobody carried the difference away. The number people agreed on simply changed. The $1 trillion didn't move to some villain's account. It was never money. It was a shared opinion about what a thing was worth. And opinions can fall. This is the part that quietly changes how you see the whole game. The stock market isn't a machine that stores wealth. It's a machine that prices it. Live. In public. Every second. And prices are just people agreeing until they don't. Let's trace your $100 one last time. The whole trip, now that we know the truth. You tap buy. The money leaves your bank and sits with your broker, the messenger. Your broker sends the order to an exchange, the matching machine. The machine finds a stranger willing to sell one share. Your $100 flows through and lands in their account. You get the share, they get your cash. And a day or so later, behind the scenes, a clearinghouse quietly makes sure the swap is final and nobody cheated. Apple was never in the room. It got paid once, years ago, at its IPO, and never again. That's where your money went. Not to a company, to a person on the other side of a trade, because that's what the stock market actually is. Not a fountain that feeds companies. A giant, roaring marketplace where millions of strangers hand each other slices of ownership and agree moment by moment on what those slices are worth. So the next time you tap that button, you'll know the truth. You're not funding a company. You're buying a stranger's slice at a price the whole world is arguing over in real time. That's not a reason to avoid it. It's just a reason to understand it. Because most people put money into something they've never actually seen the shape of. Now you have, which leaves one more question, and it's a strange one. If buying a stock just moves money between strangers, then when you buy Bitcoin, where does that $100 go? Because it's not where you think either. We'll follow that one next.